You know, this whole thing about private credit, it's sort of the flavor of the day in markets, right? Becoming more and more popular. Folks are talking a lot more about it as well. But access so far has been limited to ultra-high net worth, well-heeled individuals. And even they are talking about, when they talk about private credit, they think about the risks, that is leverage upon leverage upon leverage. What are you telling clients, though?
Yeah, well, you're absolutely right. You mentioned that it's the flavor of the day, but I think this is really something that's going to be a function of financing in many countries across the globe. As you mentioned, it's nearly 1.7 trillion deployed, another 300 billion in dry powder. We expect that number to go to $3 trillion by 2028. And that's driven by demand for financing around the world, whether you're talking about in the U.S., Europe, or also here in the Asia-Pacific region. It's growing significantly, and that's because the banks have hit capacity in many countries, and private credit is coming in to fill that gap.
Okay, and the thing is, where they're sourcing the money from is interesting, right? Because increasingly it looks like they're going down market and targeting retail investors as well as sort of mass affluent wealth platforms, which is one way to do it. But, you know, we've talked to other folks about this as well, this phenomenon. They're saying, look, you can probably get the money from there, but you're going to have to do a heck of a lot of education as well, more education.
You're absolutely right. This market has been the purview of institutional investors, primarily pension funds, foundations, insurance companies, and as you mentioned, high net worth individuals. However, the industry is looking more and more to the average person on the street. In fact, they're looking to go to Main Street. And there are risks here. Retail investors are traditionally used to high liquidity in all of their investments. And this is not an illiquid investment. So you're absolutely right. It's going to require a lot of education going forward. It's not a question of if this comes to the retail market in our view, but when and how is going to be very, very important. As you mentioned, regulation, education are going to be key to how this market develops going forward.
Yeah, let's talk a little bit more about this whole liquidity risk mismatch, which you brought up, Mark. I mean, and this is going to be important, right? Because I mean, it's sort of like in private markets, it's like PE as well. You know, the gains potentially, theoretically, can be astronomical in some cases, right? But you know, any money you put in there, you're going to have to. It's going to be locked away for a long time.
Exactly. This is typically the purview of what we call patient capital, permanent capital, locked up capital. This is not like a bank deposit where you put the money in on Monday and take it out on Friday. Typically, when this type of product was offered to retail, it was locked up for a 10-year period. What we're seeing, and as you mentioned earlier and appeared on the screen, we're seeing more what is called evergreen funds. And evergreen funds are attractive to retail investors because they can get some of their money out, usually on a quarterly or a semi-annual basis, but that is usually capped at 5% of the entire fund's assets. So again, this is not a product for someone who needs daily liquidity or even monthly liquidity. This is the type of product that would be useful for someone who is saving for their retirement, where they're putting money away and they don't expect to take it out for many years, in some cases decades.